When most people think of succeeding in the stock market, they picture algorithmic supercomputers, chaotic trading floors, and analysts in expensive suits. Wall Street seems like an impenetrable fortress. But beneath the high-frequency trading networks, those professionals are still running on ancient hardware. On the savannas of Africa, if an early human saw a sudden threat, they ran first and asked questions later. That fight-or-flight instinct kept our ancestors alive. But when applied to a modern portfolio, it practically guarantees failure. We are biologically programmed to fear losses far more intensely than we enjoy gains, prompting us to sell perfectly good assets the second the market takes a dip. When millions of people yield to this same panic, asset prices detach from reality. This predictable irrationality creates a massive efficiency gap that can be exploited by an unlikely group of investors. You might assume professional fund managers are immune to this panic. But they have a massive vulnerability: their clients. Modern technology allows these clients to monitor their portfolio returns every single day. If a manager's returns drop into the bottom 10% for even a 3-year stretch, their clients will pull their money. And without clients, the manager has no business. This creates a terrible structural trap. Even if a professional spots a brilliant multi-year opportunity, they cannot hold on to it if it requires enduring a few bad quarters. They are forced to abandon proven, patient strategies just to keep their jobs this month. This is where the individual investor gains an edge the professionals cannot touch. Without clients breathing down your neck, you are the only person in the room with the freedom to maintain a truly long-term horizon. To leverage this advantage, you need a way to filter the market. Warren Buffett famously states that it makes sense to buy a wonderful business at a fair price. To find a fair or cheap price, you compare what a company costs to what it earns. This is the price to earnings, or PE ratio. If Apple has a PE of 33 and Google has a PE of 18, Google is simply the cheaper stock. But we also want a wonderful business. That requires finding a company generating a consistently high return on capital over a long time. When you rank thousands of companies based on how cheap they are, and then combine that with how much capital they efficiently generate, you isolate stocks that are undervalued and exceptionally high quality. Most people simply dump their money into standard index funds, but these funds are weighted by market capitalization, meaning they systematically purchase too much overvalued stock, dragging down your potential upside. Investor Joel Greenblatt developed a mechanical workaround. By ranking every stock by that exact cheapness and quality combination we just built, you can bypass the standard funds entirely and construct your own custom value index. This chart tracks the value index against the S&P 500 over 20 years. The S&P returned 7.6% annually. The value index compounded at 13.9%. A $10,000 investment reached $43,000 versus $135,000. By prioritizing actual financial health of these companies rather than raw size, this weighting method mathematically outperforms traditional passive indexing over the long run. Having the right formula is useless if your biology causes you to panic during a market downturn. To survive, act like Odysseus facing the sirens. Tie yourself to the mast by committing to a rigid plan before the storm hits. The first rule of this constraint is physical. You're only allowed to touch this index and execute a rebalancing once a single year. The second rule is an information diet. Outside of major corporate event alerts, you must refuse to log into your brokerage account more than once a month. These deliberate blinders separate you from the noise. By hiding the daily fluctuations of your portfolio, you actively cut off the oxygen to your fight or flight response, protecting your mathematical advantage from your own anxiety. The final rule dictates your long-term allocation. Decide early to commit 40 to 80% of your wealth to stocks and lock that baseline into place. Because you aren't a machine, the strategy allows for a maximum 10% adjustment up or down to that allocation each year. This provides just enough flexibility to satisfy the human urge to tinker without derailing the entire portfolio. As cheaper technology makes clients even more hyper-focused on daily returns, professional money managers will be forced to become even more short-sighted. As the rest of the market loses its attention span, the payoff for playing the long game expands. You don't outsmart the institutional money managers by building a faster algorithm. You beat them because you don't have to answer to anyone but yourself. You win by wielding the ultimate asymmetric weapon, your patience. How do you defeat a towering physical giant in a one-on-one contest when you don't have a fraction of their strength? You don't. You refuse to step onto their court, and instead, you pick a completely different game to play. This is exactly the advice Joel Greenblatt gives to his MBA students at Columbia Business School. Take that same logic and apply it to Wall Street. How do you, an everyday retail investor, outmaneuver a financial titan like Warren Buffett? If you try to compete in the Diamond League by buying into giant tech monopolies, the Apples and Nvidias of the world, you are stepping onto a heavily guarded battlefield where institutional money has every advantage. Winning in the stock market doesn't actually require a higher IQ or an army of analysts. You simply need to shift the boundaries of the contest to make the massive size of institutional giants entirely irrelevant. Mega funds manage hundreds of billions of dollars. Because of that immense scale, dropping a few $1,000,000 into a small company literally cannot move the needle on their overall returns. This creates a strict, mathematically enforced boundary line. Look at public companies with market caps below $1 billion, and you'll find Wall Street's biggest players have completely stopped paying attention. This animated scatterplot illustrates the divide. Notice the dense cluster at the bottom. There are hundreds of businesses down here, over 800 in a market the size of Sweden alone, operating entirely outside the view of institutional capital. By focusing your attention on these smaller companies, you gain access to a vast, untouched inventory of mispriced stocks where the heavyweights are simply not allowed to compete. Finding an opportunity is one thing, but figuring out what it's worth is another. Wall Street typically uses complex discounted cash flow models, a method trying to map out every dollar a company will earn until Judgment Day. The problem is, most professional analysts struggle to correctly predict earnings for the next 3 months. Attempting to do it with any accuracy over a 30-year timeline is effectively an impossible task. Because absolute fortune-telling rarely works out, Joel Greenblatt proposes a much more grounded approach, replacing complex predictions with a relative opportunity cost. The U.S. Treasury offers a 4% yield. To justify market risk, we require a 6% hurdle rate. Let's test Apple. It generates massive cash, but its current valuation provides a 3% yield. It completely fails the test. You don't have to perfectly map out the next decade of corporate earnings. You only need a simple heuristic to verify if the asset sitting in front of you offers a better return than a guaranteed risk-free bond. Of course, the standard advice handed down to small investors who want to skip valuation altogether is to simply buy a market cap weighted index fund. But those funds operate under a massive structural flaw. Because they allocate capital based purely on a company's market size, they automatically buy more stock when it's expensive and less when it's cheap. Look at this 3-year Disney price chart. When the stock price soared, its index weight expanded alongside it. As new money flows in, the system mechanically forces the purchase of 50% more stock at the absolute peak than down at the bottom. It is an automated system mathematically programmed to execute the exact opposite of intelligent investing. It blindly buys high and sells low. Fortunately, there is a straightforward way to bypass this trap. You abandon market cap weighting and shift your capital into equal-weighted or fundamental-weighted funds. By holding an identical amount of every stock, or by linking your investment size to concrete numbers like actual sales and cash flows, you strip away the systemic errors caused by wild price swings. This dual-line chart, tracking 3,300 stocks over 25 years, shows the result. The fundamental index line consistently outperforms the traditional cap-weighted index by 2.7 to 4.5% every single year. Earning superior returns in the stock market doesn't mean you have to outsmart thousands of Ivy League analysts. It comes down to self-awareness, zeroing in on smaller companies, and outright rejecting flawed defaults. Your greatest advantage was never about having more money or better information. Your true edge is simply staying agile enough to play a game the giants physically cannot enter.